Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. So, unless you've been living under a rock, growth stocks have outperformed since the pandemic, particularly mega tech stocks in the Magnificent Seven, which have accounted for the majority of market gains as historically low rates in the AI boom have helped contribute to the outperformance. Well, that dynamic has shifted recently, and I have on the perfect guest on to talk about that recent shift in market sentiment. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to David Scranton. David serves as the founder and CEO of Sound Income Strategies. David, thank you so much for coming on the show. It's an honor to have you on. I really appreciate it. Now, can you start?
Great to have me, Ryan, especially about this topic.
Perfect. Good. I knew it's really interesting how the market has shifted, like I said, and it's fun to get back talking about value, income, dividends, the primary drivers of valuations in this space. Can you tell us a little bit more about yourself and Sound Income Strategies?
Sure. We started as really income right from the very beginning back in 2014. And of course, that's how, we have income in our middle name, as we like to say. But it's something that I've really been doing since 1999 when I functioned as a broker before I functioned as an investment advisor, where, for me personally, I looked at price earnings ratios back in the late 90s. And I kind of knew from my studies of market history that we were in for a pretty good bear market and it was going to take a while before things got better. So I said, this is the time I can either stick with my model and have a tough decade ahead of me and tough decade for my clients, more importantly, or I can just have the courage to change my business model when I know it's right for them. And I did the latter. And really now 25 years later, there's been no looking back.
Fantastic. You talked about ratios and valuations. A lot has been made over the years of PE and the different variations of it. And when you talk about valuations, that's usually the first thing that people talk about. What's your view on PE ratios? Do you guys still use them in your valuations? Have you expanded that to look at free cash flow?
Oh, of course. You still use it as a valuation, but you're using many, many different metrics. You're not limiting yourself to one or two, because especially in the world that we're in, at least on the equity side, not the fixed income side, on the equity side, it's all, higher dividend value-based strategies. So and the toughest part about being a value investor is you're trying to parse out whether something's cheap for a reason because it should be cheap, right? It's called the value trap, or whether something's cheap now because there is something that maybe, as you peel back the onion, the markets aren't recognizing this particular stock, in which case it could very well be a buy. It could be a good opportunity. So pretty much every metric that you could possibly use to determine valuation, we're using.
Interesting. You mentioned value trap. We talk about growth traps, value traps. And without giving away your secret sauce, how do you guys try and locate value traps in equities and, try and stay away from them? Are there warning signs or anything that, you guys use to find those?
Well, here's the interesting part of it. When I went into the income world in 1999, if you remember, the reason I went in was to protect people. So I was bonds, preferreds. That was my focus back then. I was a fixed income guy. And when, even though, of course, becoming a CFA, I studied all the equity valuations, but it's not really what I did for a long time. However, our co-CIO in charge, our PM in charge of the equity side, in bringing him on, I learned a lot about really value-based high dividend investing. He's my age, he's been doing this for 35 years in that one specialty. And what I learned is a lot of value research is subjective, not objective. In other words, we all think about, okay, let's look at the financials.
Yeah.
Let's look at market share within an industry. Are they growing? Are they shrinking? Maybe we look at some technicals and we make a decision. But for a value-based investor, really their research starts where everyone else's leaves off. So because in the reason I had to go and invest in a PM and a co-CIO that's been doing this for 30 years, and yes, I had to pay up to get this person, was because a lot of it has to do with relationships, right? When you're doing this, you have half the world that's in value thinking it's a good value, the other half thinking it's a value trap. So really, this is where you start to make phone calls and you start to say, look, why do you think this is a value? Give me top 5 reasons. Why do you think it's a value trap to the next person? Give me the top 5 reasons. And then what Eric Byrich will do is he'll actually go ahead and create a list of questions, and he'll call the company and get his questions answered. Then he might bring those answers back to other analysts, other PMs that he's met over the course of the years. Maybe feed that information to them, get a second layer of opinions, maybe come back to the company with a shorter list of questions. And only once he feels confident that there is some hidden value there, or something has been temporarily extremely undervalued under normal course, then will he go ahead and make a purchase. So the secret is there's a lot of heavy lifting. It's nothing you can do in an algorithmic fashion.
Yeah.
It's really very, very subjective.
That's really interesting. You think of value space, you're always looking at lower valuations, whether it's free cash flow and price to sales and all
Right.
those different metrics. But there's that, qualitative side that I think people miss about, talking and in relationships. That's really interesting. Usually most people just think of, like you said, financial statements.
Mm-hmm.
So
Yeah, so you put your filters there with all the
yeah.
ratios, and that narrows down the universe. So now you're not researching every single stock out there. But that's when you start to roll up your sleeves. And most, certainly over 80% of them, we dig through it and say, well, that's probably a value trap, not a good value. So in the value world, you really have to do a lot of heavy lifting. You have to kiss a lot of frogs to get a prince, essentially. Yeah.
Yeah. Yeah, that's what my fiance says too.
Yeah. Aw.
um, let's take a step back and talk about the macro landscape. Inflation has cooled. There's signs that the economy is slowing. Traders are pricing in a rate cut in September. Fed is signaling a rate cut. Markets are signaling a cut in September. How do you feel about the Fed, and should the Fed cut in September?
Well, I think they should. And I don't have access to the data that they have, everything they're looking at. But we've always known that the Fed's instruments were through the rearview mirror. They're very backward looking. And as a result, they keep their foot on the brake too long. They keep their foot on the gas too long. So just like they kept their foot on the gas too long up until 2 years ago and essentially created this inflation. Now my fear is that they put their foot on the gas for too long, or the brake too long, I'm sorry, and now have the opposite problem. So I think they need to start going in the right direction. And frankly, that's what caused this flip that you saw about 3 weeks ago from all the Magnificent Seven, if you will, leading the pack, to now other more diverse companies and diverse sectors and some good value stocks now that are, we've had over the last 3 weeks as many good days where we've outperformed as days where we've underperformed. Whereas over the last several months leading up to that, there'd be 5, 6 underperformers to get one day where we actually outperform. And I think that's because now, I guess the Fed's kind of sort of telegraphing where they're going next. So now people are saying, okay, yes, there's the typical duration argument, right? When rates go down, the longer duration stocks, like the growth stocks, the tech stocks, usually do better. But also remember, the markets are forward looking, maybe as much as 12 or 18 months. So right now it's kind of like, what they say, buy the rumor, sell the news.
Yep.
Well, that's kind of what happened with tech. And I think now everyone's selling the news And now they're looking for yield because they're thinking, gosh, if these value stocks get pushed up, that could hurt our yields. Let's lock in the yields now.
That's really interesting. I'm glad you brought that up because, NVIDIA has been the darling for the past year or
Sure.
so. It's fallen, gosh, 27% since its recent highs. And I think it's erased over $1 trillion in market cap since, June 20th or
Mhm.
so. And you talked about rates and markets are forward looking and cutting rates. Is there anything else that's driving that shift to value in small caps? And do you think that shift in um, the rotation to value in small caps will continue?
I think it's going to continue for a while, yes. And then maybe if we start to sense that we're just even sensing we're getting to the end of the lowering, then things may change. Of course, all bets are off. You have recession, then pretty much, tide goes out, all the boats start to come down. And that still could happen. That still could be in the cards. So we're seeing the rotation now, at least for the rest of the year. What happens after that really depends upon the economic news. And where we go. And I also think there's a bunch of people that have been smart enough to lock in some good bond yields lately, with bonds and preferreds and so on. Again, that's kind of in my blood, right? And I've been able to do that for such a long time, so it's been really neat to be able to get out there and get people some really competitive yields. But yet, there's some people that want yield, but they want that upside. They just don't want to be in fixed income. And again, that's driving that now and is likely to drive that for a while.
It's interesting you brought up fixed income. I typically focus on equities. And when I started this podcast some few years ago, everyone wanted to talk about equities. Now, in the past, I don't know, 6 months, everybody wants to talk about fixed
Sure.
income. It's interesting, and I don't want to, you know, hurt any, fixed income and the bond guys their feelings, but bonds were really boring for 40 years, right? When interest rates were coming down and you had that bull market for bonds. Now over the past year and a half, 2 years, they are really an interesting, fascinating, good talking point.
Mhm.
And I think it's going to continue moving forward too.
Well, it's interesting. We have what I call bonds and bond-like instruments, where
Yes.
we do bonds and preferreds and leave and pepper in a little bit of BDCs.
Okay.
And I will tell you that, and not a lot, but I will tell you, we have, even the bowels of the interest rate environment, been able to get a 5% yield, just pure income, going back 3-4 years. So we've always been able to get a good income. Now, obviously, our yield is much, much higher, and it gets exciting. So we had a tough year, when rates started coming up. So we had a really tough year in fixed income. But then after that, everything's been pretty strong. So yeah, I think it's going to continue because, it's just when you could start to get 5%, even if you're talking about triple B bonds, that starts to get pretty competitive where people say, that's
Mhm.
enough. That's really all I need. When we're looking at 3%, maybe not. So we'll have to see, but I think that's going to stay strong for a while because I don't think rates are going back down to where they were.
Yeah.
Fed funds rates may level off in the mid high twos, maybe 3%. The 10-year will come down, but not as much as you think because the yield curve's inverted, right? So it's going to uninvert. In fact, that's one of the mistakes that people have been making. And I know you don't like to talk bonds, but yeah, but one of the mistakes is people saying now, well, rates are coming down, go long term. Well, okay, I get that and that logic, but when you really dive into fixed income, you can buy shorter term bonds, and as the short end of the yield curve comes down faster,
Yeah.
those can go up in value. You do what's called rolling down the yield curve. They get closer to maturity, you flip them out at a profit. So we've actually held off in going longer term because
Good.
we think there's a lot more to be squeezed out of the short term stuff. That short term comes down and long term doesn't come down quite as much.
Interesting that you're still finding opportunities and
Yeah.
optimistic about shorter duration securities when everyone's talking long duration. you know Fixed income, it's really interesting, and I've done some research just recently, the impact of falling rates have on equities and fixed income over the past you know rate cutting cycles. It's fixed income, it's that total return opportunities that's really attractive to investors. Falling interest rates, and like you said, it's all about that recession and economic data. On the equity side, it's uncertain.
Mhm.
Why is the Fed cutting rates? Is it because we're going to go into a recession? Well, that's not good for equities, and it hasn't been. But fixed income, there's a lot of opportunities there for even if we're not going into a
Mm.
recession.
And what's more important is if you have some conservative clients that are close to retirement or are retired, they get a chance now to lock in such a better yield. So yeah, you're thinking total return, and I get that because you think like an investment manager, right? But your average client who's retired or close to retired is just saying, I can get more income today off my $1 million than I could 3 years ago. So, if you can get that and you can live off, you might want to lock it in a little bit longer. And then you just make sure you do other things to have an inflation hedge, right? Because people are living longer.
Yeah. And you brought up a good point about how when interest rates were, we had the steepest interest rate hiking cycle in 40 years, and all the pain that was caused with fixed income investors. But to me, I hate to say this, there's a lot of listeners out there that really felt the pain. It was needed, right? Because now, like you said, now all these retirees who have been going out across the risk spectrum to get income, now they can finally get some decent yields in places that traditionally have, should be yield income producing securities, and now they can get it in safer securities.
Yeah, that's right. It's a good chance to do that. It's also a great chance on the security side, with some of the higher dividend yielding equities that have been out of favor. It's a great chance to get in there a little bit cheaper if you still want that upside and get a decent yield. One of our strategies I think as of today is a 4.7, 4.8% yield for equities.
Yeah.
That's great for the equity world. I mean, you weren't able to get that in fixed income 3 years ago, and now you're getting it in equities. So there's opportunities everywhere. You just have to look. And to me, that's the message I like to send financial advisors: is don't be stuck. Don't be stuck in your way of thinking. That's what saved my bacon back in 1999. My business exploded. We used to, as a broker, we used to judge GDC, right? So I was doing like 300 some odd thousand of GDC in 1999. By 2006, I was doing over 3 million of GDC, and I was getting a 90-95% payout. So I was doing really well. But it's because a big part of it, because I became known as the income guy. I became known as somebody who did something different, where people back then would say, hey, you want growth, you want total return,
Mhm.
go to Shearson Lehman, go to AG Edwards, right? All those companies that used to be around. You want income, go see Dave Scranton. And by doing that, that's the one single move that I think really helped my business explode. And it wasn't out of greed. I wasn't smart enough to think about that.
Mhm.
What I was smart enough to do is to know that I need to protect my clients. So that's what I always encourage people to do: is if you have a certain model that you learn, don't be stuck with that model. You have to be flexible for the benefit of your clients. And not only will it help them, but you can hit that moment that I hit in 1999 where your practice just takes off. And that's the key. Do the right thing for people, and
Yeah.
word will get around.
Yeah, that's a great point, and a perfect segue to, we talked about how growth, income and value was out of style after the pandemic growth and mega tech stocks. How do you talk to, like, if you were an advisor back then or an advisor to, what are some of the things that you talk to clients and investors about why it's important to continue to maintain an allocation to equity income and income strategies when they might be
Yeah.
out of favor? What are some of those? What's the messaging you use?
So I'm going to talk to the advisor, and then the advisor has to figure out how
Perfect.
to water that down to the client, because some clients are more sophisticated than others, right?
Yep.
But the answer is simple, right? I remember going for my CFA and studying about how over the long run, 40% of the return in the stock market came from dividends. And I'm thinking, okay, the market average is 10 or 11%. So you'd think that means the average dividend would be 4.5.
Yep.
But the average dividend across the S&P 500 is what, 1.3, right?
Yeah.
So how does that math work? It doesn't make sense. And all these articles in academia would always talk about how 40% of the return over the long run came from dividends, but they wouldn't say why. So finally, I figured it out. I figured it out by doing a pretty detailed analysis. And what it has to do with is dollar cost averaging. You see, when somebody's young and they're putting money in a 401k and they have a few dollars in there, but they're channeling a bunch in, that ratio of new money to old money, if it's higher, it creates a better dollar cost averaging effect. But as you accumulate more wealth as you get older, whatever you can put into an account every year is small in comparison to the old money that's sitting there. So, but when you have dividend stocks, you dollar cost average. So think about that 2000 to 2012 period, right?
Yep.
If you were in growth or even the S&P 500 blended, you were underwater for 13 years. But what if you got a 4% stock dividend? Over 13 years, instead of being barely back to even in 2012, you would have had 52% more shares, right? Because 4 times 13 is 52.
Yep.
So now instead of being even as a dividend investor, you were up 52%, right? But you really up more. Why? Because you bought more shares in the troughs. You were up 75 to 80% with it as a dividend investor, whereas the growth investor was barely even. So what I found in doing the mathematical analysis is that if the market goes up in a straight line, growth and dividends have the same power. It doesn't matter whether you're growth or dividend based. However, we know the market doesn't go up in a straight line. And the dips give dividends a mathematical advantage. So, because the dollar cost averaging. So think of it this way, right? Ryan, you would come to my office in Fort Lauderdale and we'd say, let's have a contest. Let's see who could pedal a bicycle for 20 minutes the longest, right? But we have a choice. We can get out of there, get side by side, we could pedal our butts off and see who poops out first, right? Probably me because I'm older.
No.
But then, what's the other choice? The other choice is, Ryan, you can sneak up behind me and say, I'm going to draft off Dave. I'm going to save 30% of my energy. And when he's about ready to quit, I'm going to pull on the side of him and blast by him. So you see, when we've all studied, oh, you want to get more return, you got to take more risk, right? That's one way, but that's like pedaling the bicycles right side by side. But there's a second way to do it, and that's to let the math do the work for you. And that's where dividends come in. Draft off the other person, save 30% energy, i.e. 30% risk, and then let the math do the work for you. And when the dips come, that math will, because the dollar cost averaging effect. So that's what I teach when I do keynote presentations at conferences, like I'm going to be doing in a week and a half. I have one. And that's what hopefully your listeners, Ryan, will pick up on, and then be able to find a simple way to communicate that to their clients.
I love it. That's a fantastic message, way to break it down on why you should continue to invest in and keep an allocation to income, whether the strategy is out of favor or in favor. Love it, David. We can't have this conversation or talk about markets about that thing that's coming up in November, that election. Should investors be worried about it? I don't talk too much about politics, but do we make too much about it? Markets tend to go up regardless.
No, Ryan, we don't make too much about it. Our clients make too much about it.
Okay.
Because think about it, the old saying was, well, Republican administrations are better for the market, Democratic administrations aren't as good. But yet, if you go back, the market wasn't that great during George Bush Sr. It was great during Bill Clinton. Wasn't that great during George W. Bush, right? It was actually pretty strong during Obama, right? So in the market now is strong under Biden. So I mean, I think there's way more into it than an election. And I hate to see it. I can't tell you the number of new clients we got in my office here in Connecticut. Of course, Connecticut's very liberal. The number of new clients that we got at the end of 16, because they were just petrified of what a Trump administration would do to the stock market. They were just petrified because of their beliefs. And it's great. We got a whole bunch of influx of capital, but did it really make a difference? It didn't make a difference one way or the other. So, I tell people to make sure they stay relative to like simple stuff. We've all learned this, right? What are your financial goals? What are your time horizons? Do some really honest reflection with your risk tolerance. What is it really, right? Because everybody thinks they're more risk tolerant until something bad happens, right? And then they'll come running back to us, jumping in our arms, help me. But wait a minute, you just said you were a more aggressive investor. Well, they thought they were aggressive. They really weren't. So I think we need to do a better job at assessing risk tolerance in a down market, and really making sure that we don't let people try to keep up with the Joneses. Just because last couple of years their neighbor was Nvidia, and at every cocktail party like to brag about all the money they made. If your client is more conservative than that neighbor, maybe the neighbor is more conservative than he or she thinks too, then just keep communicating with those clients as to why they're on the right path. And that's the key: communication, communication, communication. Don't be an order taker, is what I tell people. I'm aggressive. Great. Well, I'm going to help you do that. I'm conservative. Great. I'm going to help you do that. Don't be an order taker. Figure out what they really are and make sure. And even if it means you lose a client now and then, you're not telling them what they want to hear. We're fiduciaries. It's our job to do the right thing.
I love it. I think, one of the biggest risks to investors is that fear of missing out, FOMO.
That's right.
Bitcoin, it's usually going to be too late by the time you think about it. These meme stocks, you name it. And that's what you're talking. You talk to your buddy, your neighbor, and you got that fear of missing out. They hit Nvidia, you didn't, you get in too late. I love it. Keep it simple. Don't lose track of the trees through the forest. Focus on you, your objectives, your risk tolerance. It's so important. And long term. I love that advice. That's great. Let's talk about your firm and your investment strategy real quick. There's different ways companies can distribute income to shareholders, and we've talked a lot about dividends. There's share buybacks. There's debt reduction. How does your firm and how do your equity income strategies, differentiate themselves from others? And where does your investment team locate market inefficiencies?
Well, our whole concept with consumer, our whole brand, and this is what I was trying to say a minute ago, too. If you're going to specialize, you have to determine, okay, who you want to be as a firm, and stick to that. Don't jump off the reservation just because someone wants something different. If you truly feel that your job, that what you do is right for this person, it's your job to be persistent and try to educate them. So for us, it's all about really the only income you can count on is interest and dividends. And annuities if you're licensed to do annuities, right? But that's all the income you can count on is interest and dividends. Everything else may happen, may not, right? So that's why everything we do is based upon consistency of income, making sure we can count on that income continuing for people, because a lot of our clients want the income or need the income. It's funny, it's amazing how liberating it is when you can teach a client that who thinks they need to scrimp and save in retirement. They need to clip coupons. Somebody just this weekend reminded me about green stamps, and I went, "Oof, that's a flashback." I barely remember green stamps, right? You may not even know what they are, Ryan. You're too young, but it's all when you could tell somebody that, hey, we can liberate you. You can spend more money in retirement than you think, and you can get it without touching a dime of principal. You can do it through a renewable resource known as interest and dividends. That's liberating. So everything that we do in our secret sauce is to make sure that those interest and dividends continue or go up, that they don't get cut. And that's a big part.
Yeah, it's not just about companies that produce dividends. Are they growing dividends? Are they, or is it shrinking? That's a great point, and one thing that you hear a lot about. Thank you so much, David, for coming on the show. It really was a fascinating conversation. Thank you for sharing such great insight. I learned a lot. I think our audience will too. You covered a lot.
Hey, we talked about my favorite topic. I appreciate you having me here, Ryan, for sure.
Awesome. Where can our listeners get more information about sound income strategies?
They can go to soundincomestrategies.com or even soundincomeGroup.com.
Okay.
Sound Income Group is our parent company.
Fantastic. In preparation to our conversation, I went through, you guys have a lot of great information, resources, blog articles, a lot of great thought leadership on this space, whether it's fixed income or equity income. So I loved it. So
good. Ryan, thank you.
Thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.